Welcome to our weekly Forex and Futures forecast. My name is Jay Norris. I teach market analysis and trading at Trading University. First market we'll take a look at this week will be the Australian US dollar. Aussie US dollar had a nice breakout here. You can see it took out that intermediate term level, shifted things higher in a hurry. Very beneficial from a day trader's perspective. Once you see that happening, once you see that level taken out, and you just shift quickly to buying dips short term on the intraday charts, and that would have been the way to view that. You can see I put the patterns on the chart. Pretty simple way for us to analyze these markets. It makes it easier for me also in explaining them. Short term higher, intermediate term higher, long term however still lower, and I think that sums it up pretty good. You have some room on the upside here, so from our perspective as a swing trader and as a day trader, we'll focus on the long side here. Though I think overall though you're going to have a somewhat limited upside in the Aussie given the long-term pattern is down. We're big believers in pattern recognition, technical analysis essentially, big believers that the pattern on the chart is going to be the best reflection of the underlying fundamentals, be it government policy, demographics, certainly economics. So we think the way to follow along with that, keep that sorted out, is by the patterns on the chart. Next market we'll take a look at will be the dollar Swiss. No surprise for me, I'm pretty bulled up on this market. You guys have heard me in the past calling this the trade of the decade and really the investment of the decade. I just put one pattern on the chart because I think that's really all you need. Definitely you want to be a buyer on a potential test of that 98 even level. If I like it at 98 even, I love it at 96 even. So pretty bulled up on that guy. Pretty simple story. You know, Switzerland, landlocked country there that is surrounded by Europe, versus the United States. So this chart you're looking at, it's a dollar pair, dollar Swiss, so you're long the dollar, short the Swiss. So we think the Swiss would have a tough row to hoe there competing with the United States, and we just think there's a ton of room on the upside in this market. It's a bull. Next market, the dollar index. There's dollar index, just two patterns there, kind of a short term and an intermediate term for you. We like buying dips in this guy. We think these levels will be ones definitely to watch. Again, just like the dollar Swiss, you know, if I like it here, I love it down there. Sure, short term, looks like you have a little bit of downside. In fact, even as a day trader, you may end up working that guy from the short side. Nothing wrong with that. Longer term, though, from an investor standpoint, for sure, we think you want to maintain longs in this guy. From a trader's perspective, from a swing trader's perspective, even, boy, I'm not even sure. I guess you'd be on both sides of that market right there. Next market, the euro. I think the patterns put things in perspective pretty well there. You can see I kind of tipping our hat there. We have a sell zone there. Short term down, intermediate term up, long term down. Essentially, you have two patterns down. When you're in a situation like that, you have essentially three successive patterns, meaning the short, intermediate term, long. 2 out of 3 are down, so generally that's the direction we're going to focus in. Keep it simple, and there you got a nice sell zone on the chart right there, so we'll have to keep an eye on that. So we're definitely interested in selling rallies in the euro. From a shorter term trader's perspective, we'd still be on the long side. Boy, swing trader, I'm not even sure both sides really. As a swing trader, from a longer term perspective though, you want to be selling rallies. From an investment standpoint, you want to be short this guy. Awful hard to compete with the U.S. right now. You just had a U.S. employment number came out, just a gangbuster number, great number, added 240,000 jobs to the economy when they were looking at just a little below 200. So they're continuing to see good numbers as far as adding U.S. jobs. You're seeing interest rates in the United States normalize. That's telling us that the expansion that started a couple of years ago is starting to gain traction for sure. And Europe can't necessarily say that right now. So as the global economy starts to gain footing, pick up speed, we feel it's going to be the United States is going to lead the way. Happy to see also you had a nice bottom in the Chinese stock market recently, and they're starting to recover nicely as well on the stock side anyway. But we think overall, you know, there'll still be some tough sledding globally, but it's going to be the U.S. that's going to lead them out of that, and that's going to mean a stronger dollar. It's meaning normalization of interest rates first, then the strong dollar. Next market, we'll cover the U.S. stock market. I don't think there'll be much need to cover this guy anymore if it can break out just a little bit higher. A little bit of a concern here because you could see you have an intermediate term down, a little bit longer term still down also. You're at a critical level here though, a little above 2,000 in the S&P 500. They really need to get above there. They need to close above there a couple of times. It wouldn't surprise us here if you do get a dip in there. As I said before though, we like it down in this zone. We think that's the time to start to accumulate U.S. stocks down there. So the stock market looking good overall. It's just a daily chart, but you peel out to a weekly chart and it's looking pretty good there. You had our buy zone there held. You had a nice double bottom in there, so we like that. Hey, if it did happen to retreat in that zone in March sometime, I imagine we're not going to see the best U.S. economic numbers in March because February, very slow time of the year. Obviously, the numbers we get in March are actually the data from February, so you'll still see some slow numbers in the U.S. coming out. However, we think as the closer you get into the spring and the further then you get into the spring that things are really going to pick up nicely. So we like the idea of buying dips here. Can't be too enthused about the S&Ps or the U.S. stock market just yet until you take out that level right there. You're right at it now. So it made a real nice recovery following that double bottom. It's got a little bit further to go though, but if it did happen to dip into that big wide buy zone down there, we'll definitely take an interest in that and buy some more there. I think just as a rule of thumb, you want to buy the S&Ps down in there. Keep in mind the S&P 500, that's 500 of the best companies in the world, not necessarily just U.S. companies overall. I mean, they just have that huge global footprint, so it's really hard to compete with them. So if they're going to find a way to be profitable, successful, they generally do. They always have. So that's really why you tend to have a perpetual bull market in that guy. We'll take a look at gold. I keep saying I'm going to look at this guy closer because I think you're at a critical level here, and I just haven't had the time to do it. Let me pull out to a weekly here, and you'll see gold's come a long way. I have to say, though, in the past, gold been a leading indicator market for sure, but if you look back what's happened in the past 5-6 years, you'll see that really the stock market is the leading indicator, not gold. Gold, though, you can see it's right underneath pretty serious resistance. It's taken out resistance on the way up here. But here's why I can't get excited about a bottom in gold, because it went from basically making a lower low to a lower high. Generally, you want to see a lower low followed by a high, then followed by the second higher low. So generally, I don't get excited about a market that the last move down was a lower low. I want to see a higher low and then a move. But gold still in the same place it was 2 weeks ago for me. Anyway, it's a little bit higher in price wise, but look at that, you're right below key resistance. I'll definitely step out at 1300 and short some gold there, use some leverage. But for now, I can't get excited about it. Sure, it's a big move, but it's a commodity, and people think, oh, gold, it's a big market, everyone knows about it. It's not a big market. It's a very small market, technically, as far as the actual volume in there. It's a very small market from a volume standpoint compared to the different markets we do look at. And there it is. You see it. It probed above resistance. It backed off a little bit, but to me, yeah, you had a big trend shift here, no doubt about it. You swept all the short term, all the intermediate term, even a lot of the long term patterns higher. But you go out and you look at again a couple of years out, and you're at pretty significant resistance here. So I think gold, it's a commodity. That's what commodities do. They tend to overshoot on the upside and the downside. Here's what I wanted to do to put gold in perspective. Here, I've measured out, see that dead cat bounce you had there, that big rally in gold following the collapse? I put a line on there to measure the distance from the high and the low. So I'm just going to take that same line and I'm going to slide it over here. I'm going to see how it comes in there, and you can see that you actually had this rally, that dead cat bounce following the collapse, was a little bit bigger than gold's rally now, and you can also see where it ends right there at that 2/3 level. You take the top of the dead cat bounce down to the low, and you've got a 2/3 retracement coming in there a little above 1300, and that would definitely be an area on the chart that I'm going to step out and sell. Dow theory, Charles Dow said it, a market can retrace up to 2/3 of a move and still maintain that primary trend, primary pattern. So that's where we're at in the gold. Big pattern there, long-term pattern out there, still bearish. U.S. interest rates, the last market we'll take a look at, the 10-year note. Here's what I'm talking about a normalization in interest rates. There's a weekly chart of that. You can see that key two-third level there in the notes here. We can see it on the monthly chart where you could never get a close above there. You probed above it, but you couldn't get above it. We think this is a major lower high. You can see you had a bull market, higher high, higher low, higher high, higher low. Boom. Guess what? Potentially lower high. We think you have a lower high in place. We think interest rates are going to normalize in the United States. We think the Treasury is going to start to come off here a little bit, and that's going to spell, guess what? Slightly higher interest rates in the United States, and we think that's just the beginning of it, of the normalization in interest rates, and we think that's a reflection of a stronger economy. So a lot of cool things happening here. There's your daily chart of the 10-year note. You see pretty big move there. They took out some pretty stiff support right there, sliced right through it. So we think there's more downside in the 10-year interest rates, and that's generally going to mean higher interest rates in the United States. So again, you add it all up, and it seems to me it's coming up bullish dollars. Thank you so much. My name is Jay Norris. I teach at market analysis at Trading University, and we'll see you next time.